Somewhere in your home loan document, there's a clause the bank spends about 30 seconds explaining, right in the middle of a stack of paperwork you are signing to get the keys. Most homeowners don't even remember making a decision there, but that 30 seconds decided something huge. If you are suddenly gone, does the remaining loan balance get written off, or does that debt lands on whoever inherits the house? Here's what most people don't realize. A mortgage doesn't disappear just because the borrower passes away. The bank still wants the outstanding balance settled. If there's no protection attached to the loan, that balance becomes part of the deceased estate, meaning your family either has to keep servicing the payment, sell the property to clear the debt, or use other assets to pay it off, all while grieving and often while the rest of the estate is still tied up in the legal process. This is exactly the gap that mortgage protection is built to close. And in Malaysia, there are two options, MRTA and MLTA, that most people sign without really understanding the difference. MRTA, Mortgage Reducing Term Assurance, is the one most banks push at signing. The coverage amount reduces over time, roughly matching your outstanding loan balance, and usually a single lump sum premium added to your loan. It's cheaper upfront, but it's tied to that one loan. If you refinance, switch bank, or sell the property, that coverage doesn't move with you. MLTA, Mortgage Level Term Assurance, works differently. The coverage amount stays level throughout the policy term instead of shrinking. Premiums can usually be paid monthly instead of as lump sum, and critically, it's not tied to a single loan, so you keep the coverage even if you refinance or move properties. It's often positioned as the more flexible option, though it does typically cost more over time than MRTA for the same starting coverage. Neither one is automatically the right answer. It depends on how long you plan to hold the loan, whether you expect to refinance, and what your family actually needs the payout to cover. If you're not sure which one you actually have, or whether you have either, that's worth checking because a lot of homeowners find out the hard way. I break down things like this regularly. More of these are linked in my bio. Most people skip properly understanding this because it happens in the middle of the loan signing process, buried among dozens of other documents, at a moment when you are focused on getting the keys, not on a hypothetical scenario 15 years down the road. The bank officer explained it in about a minute, you sign, and that's the last time most people ever think about it until something goes wrong. In practice, this isn't complicated to fix. Usually start with pulling up your existing loan agreement to see what, if anything, is already attached to it. From there, it's a straightforward comparison. What coverage you have now, what gap exists between that and your actual outstanding loan balance, and whether MRTA or MLTA or a combination makes more sense for your specific loan and timeline. Most of this can be reviewed without multiple in-person meetings. This matters most if you are the primary income earner on the loan. If you have young children who needs to stay in that home, or if you have refinanced in the past years, because refinancing sometimes changes or drop the coverage you originally had without anyone flagging it clearly. If you have never checked what's attached to your home loan, that's worth 10 minutes this week. More breakdowns like these ones are linked in my bio.